Hi, everyone. Welcome to the Rum Report and Placer.ai webinar. I'm thrilled and excited to have Elizabeth LaFontaine with us today, who is the Director of Analytical Research for Placer.ai. And we have a wealth of information to share with you on consumer shifts, category winners, and of course, we must talk about holiday too. So, Elizabeth, let's go ahead and get started.
Okay, perfect. Hi, everyone. Thanks so much for being here today. Really excited to talk about, again, the wealth of content that we have. There's been so many emerging stories in 2025, some good, some a little bit more challenging for the industry, but I think that there is still a lot of positivity that we can take forward, and we'll kind of recap where we've been so far and where we're going. So, just to kind of give you a brief kind of overview of what we're going to be talking about today. First, I'm going to briefly introduce Placer.ai, what we do, what we cover, as well as kind of our point of view within the retail industry. Then we're going to kick into some of 2025 sort of key retail insights, as well as sort of what we're thinking about for the holiday period. And then we will, of course, save a few minutes for questions overall. So just to
So,
kind of, oh, go ahead, Shelley.
no, I was just going to say, speaking of questions, as everyone's getting settled in for your great insights here, if you have questions, please use the Q&A box. We'll be collecting those and we'll be addressing all of your questions at the end of the webinar today. So, Elizabeth, I will turn it back over to you.
Thanks. So to give you a brief overview of sort of who Placer.ai is, what we cover, what kind of insights we're able to provide to the industry. So we are kind of at our core a location analytics company powered by mobile data. What that really means overall is that we leverage a panel of tens of millions of devices across the United States, and we're able to measure foot traffic to physical locations across the US. So this could be places like retail locations, shopping centers, restaurants, entertainment venues, theme parks, municipalities, movie theaters, essentially anywhere that we can draw a box around that consumers are visiting on a daily basis, we're able to get foot traffic insights about those locations. Everything we do is with a privacy by design approach. So we are only receiving the longitude and latitude of those devices, no personal identifying information about our panelists. But what we're able to do is leverage the panel again of tens of millions of devices and then apply machine learning techniques to those panel of visits to really estimate for total foot traffic across the US at any given time. So with that, there is really a wealth of information that we have and a lot of different and interesting insights that we're able to provide about the retail industry. So we're not only able to look at kind of total foot traffic as well as year over year variance in foot traffic, but we're really able to get to some of the whys behind what consumers are doing and how they're moving throughout all of these different physical venues. So we've helped retailers with things like campaign effectiveness to really understand if they're driving a marketing or advertising campaign, are they seeing a lift in foot traffic in those areas that they're deploying? We're able to look at site location to help retailers make the best decisions about new sites or maybe refurbishing current sites within their store fleet. We're also able to layer on a lot of third party information on top of our data because we're not, again, getting any of that personal identifying information. We're able to work with third party data providers to get some of those demographic and psychographic insights as well to really understand the who behind who is visiting these different retail locations. We're also able to look at visits by day, visits by hour, visits, where else those consumers are visiting when they're visiting retail locations. So again, a wealth of information that we're really able to provide to the industry and really have a pulse on what's going on from a physical retail perspective.
What I love, Elizabeth, about Placer AI is you can take information at a broad level and you can dive super deep and really help retailers be effective at many levels. So let's kind of start with talking about, give us your view on overall retail. Give us a bird's eye view of what's happening in retail.
Yeah, that is a great question. And I think that if we had one word to define 2025 so far, it would be volatility. I think that the way when we were coming into this year, we had a lot of expectations. We felt like consumer sentiment was on the rise. We really thought a lot of these industries that had really kind of decelerated since the pandemic were going to rebound in 2025. And really none of our expectations as analysts in 2025 have been met. We've seen so much change in the consumer over the past 11 months. We've seen so much evolution with how consumers are reacting to the retail industry, how they're thinking about their purchasing decisions differently. And that's really created a lot of volatility and a lot of headwinds for the retail industry overall. But there's still, I think, some positive momentum in a lot of areas and a lot of learnings that we can take from this year to really help us be in lockstep with the consumer going forward as we continue to face kind of a tumultuous economic environment for consumers. So to kind of get things kicked off, as Shelley said, we're going to start with a super macro overview of what's going on, and then we're going to start to kind of chip away, looking at category specific insights, as well as kind of some interesting key trends that we've seen emerge throughout 2025. So what you are looking at here is what we call our Placer 100 index, which looks at the top 100 retail and restaurant or retail chains across the US and their performance year over year in terms of monthly visitation. So throughout 2025, again, it's really been sort of a roller coaster of performance. There has been a lot of volatility. And a lot of that is really due to, I think, the knowledge that consumers have and the fact that consumers are more savvy than they've ever been in the past. So when we think about the fact that consumers are really locked into what is going on around them, what is going on with their personal, economic, and financial situations, what is going on with the job market, and various headwinds that are coming their way, consumers are really reading and reacting in the moment and making those retail purchasing decisions as close to the action as possible. Meaning every single week they're thinking about, okay, what's my share of wallet this week? How much money do I have to spend? Do I have some discretionary income that I didn't have maybe last week or last month? And they're making those decisions in real time. So interestingly, as we sort of look left to right and sort of how the year has progressed so far, we did really see kind of a blip as we got into April and May, which we saw kind of rising consumer confidence. We saw a rebound of the stock market at the time. And we also saw a lot of pull forward demand for the anticipation of the tariffs that were implemented later on in the summer. So a lot of those big ticket purchases or larger items or purchases that consumers might have been putting off, they were able to make those sort of in the middle of the year in anticipation of things that they saw maybe coming a few months down the line. Now, since we sort of entered Q3, we've started to see definite softening and deceleration of visitation overall. And this is again kind of driven by more macroeconomic concerns with consumers. We have seen government shutdowns. We have seen larger unemployment numbers than we anticipated. So a lot of these things are kind of creating multiple headwinds for the retail industry and for consumers in general. We'll kind of dig into the ways in which consumers have sort of been altering their purchasing and retail behaviors over the past few months. But we are starting to see a definite softening in the industry. And as we look ahead to holiday, we're definitely expecting softer visitation numbers overall, especially when we think about kind of those key discretionary categories. However, there are definitely still ways that retailers can take advantage of what consumers have to offer right now, because we know that even despite all of these headwinds, our consumer tends to be very resilient and they are going to find ways to spend and engage with the retail industry when they feel comfortable to do so. So kind of again, digging one level deeper from sort of that super macro view, wanted to dig into both sort of the non-discretionary side of the business. And then on the next slide, we'll head into the discretionary sort of insights in what we're seeing right now. So I think sort of the key takeaway from the next two slides is that one of the things that consumers are really doing right now is looking for the balance of needs versus wants. And what we have seen and kind of what you can see on the screen here throughout 2025, again, year over year change in visitation, is that consumers have really been focused much more on the needs category than the wants category. Those are the areas where they're not willing to sacrifice the retailers that they like to shop. They're not necessarily willing to sacrifice the products or the frequency that they're shopping. That's really where they're focusing a lot of their energy right now. And so we haven't necessarily seen the huge deceleration in visitation in the non-discretionary side the same way we have in those kind of key discretionary categories like apparel and beauty and some of the others. So really what continues to win right now is value orientation for consumers. So think about value-based grocers, think about dollar and discount chains, warehouse clubs, all of these retail formats that are kind of formulated specifically to provide inherent value to consumers continue to be the winners overall. And again,
And
as we're thinking, oh, go ahead.
Now, I was just going to say, Elizabeth, if you don't mind, some of our viewers may not know the description of superstores. Can you talk to us a little bit about who falls in that category?
Yes, of course. So your superstores would sort of be considered your key mass merchant retailers. So Walmart or Target or those types of retailers. And then warehouse clubs would be consistent of your BJ's, Costco, and Sam's Club. So sometimes we look at superstores sort of holistically. Here we're breaking them out to look at true mass merchants versus warehouse clubs here.
Great, thanks.
Of course. And I think that ultimately what we're seeing is that when consumers are willing to come out into the retail industry, they really want to know that they are getting as much value out of those purchases as possible. We've also seen a lot of trade down into those dollar and discount chains. They continue to expand their assortments. They continue to open new store locations and open in new environments they might not have been in before. So ultimately, consumers, again, focusing on needs versus wants. And when they are focusing on those needs, they're trying to derive as much value as possible. So by contrast, and kind of looking at the slide doesn't necessarily kind of spell doom and gloom, but we're going to kind of get into what we're seeing behind the curtain a little bit. So looking again, year over year change in visitation on a monthly basis throughout 2025. But here we're looking at sort of these key discretionary categories. So here we're comparing consumer electronics, home improvement, clothing, which would capture both sort of full price apparel retail, department stores, and off price retail. And then fitness, which would be your traditional sort of fitness boutique locations, as well as your gym chains across the US. So I think what's really interesting here is that some of the areas that we actually expected heading into 2025 to do pretty well were areas like home improvement and consumer electronics, because these were categories that were purchased with fervor during the onset of the pandemic when everybody was stuck at home. And since then have sort of been a little bit softer in terms of their rebound from that high that we really saw in 2020 and 2021. So we expected that as we came into 2025, we were comping sort of 5 years since the pandemic, we might see a rise in some of these categories. Now, this has not necessarily come to fruition in the way that we might have expected. Consumer electronics, again, between consumer perception of tariffs, kind of pushing large ticket purchases if consumers didn't need them, innovation in the category, we haven't necessarily seen a huge consumer demand for those types of products. Now, home improvement, where we have seen a little bit more momentum is in sort of the home decor and furnishings categories. But when we're thinking about sort of major home improvement, major projects, again, consumers are sort of been a little bit more hesitant there. Now, clothing, we're seeing growth, but really, as we're going to dig into this a little bit more, most of that is coming from the off-price channel, which continues to be sort of the rock star of 2025. And we're seeing full price apparel really not perform as well as the off-price part of the business. And then fitness. So what's really interesting here, and this kind of bleeds a little bit into the clothing category as well, where we are seeing kind of slight bumps in the full price apparel performance, is we're seeing the impact of increased GLP-1 usage across sort of the retail industry and how that's changing consumer behavior in a lot of ways. So as we've seen kind of a consumer focus on health and wellness, we have seen an increase in visitation to gyms and other fitness centers. We have seen that as people are losing weight or altering their lifestyle on GLP-1 medications, that there is a need for new apparel. Consumers, again, trying to look to get the best value as possible, but there has been sort of this increased interest. So really, consumers are looking where when consumers have discretionary income available, they are really focused on these categories of self-reinvention, reinventing themselves, reinventing their homes in ways that are not going to break the bank for them. So this is looking sort of holistically of who is doing well so far within 2025 and sort of laying the groundwork by category of where we're seeing the momentum and where we see much stronger headwinds for certain categories in the retail industry. So this is looking at kind of in totality, the year over year change in visits so far from January through October of this year. And again, I sort of buried the lead on the last slide, but off-price apparel continues to be the huge winner here, that this is an area that has done exceptionally well at maintaining the momentum of the consumer, continuing to find ways to excite and delight consumers. We know that both the treasure hunt element as well as sort of the minimal online presence of off price has really bolstered them, as well as, again, that value orientation that when consumers have discretionary income available to them, again, they're trying to derive as much value out of their purchases, and they know that off price can really get them to the place that they want to be in multiple ways. There's the great retail experience that they have, there's the value that they know that the retailer can provide, and there's also the fact that they want to come back and find new things and discover new things quite frequently. Now, I mentioned this on the last slide as well, but home furnishings has also been an area of growth that we've seen. And this has really been driven by consumer interest and, again, sort of reinventing themselves and their homes in small ways, not necessarily taking on these huge, large scale projects, but just changing out pillows, changing out some home decor, and maybe getting new towels, new sheets, those types of small things. We've also seen a huge increase in the demand for home decor. So thinking about sort of seasonal home decor, like decorating for fall, decorating for Halloween. We are now in the midst of the Christmas and winter holidays, so decorating for those holidays as well. Those are, again, sort of these small things that consumers are doing to make themselves feel good, and that's benefiting home furnishings overall. Now, the kind of last one that we're seeing growth in is luxury department stores. And this is really being driven by some of the major players in that category, including Nordstrom, which has continued to have a really strong 2025. And we're going to get into this concept a little bit more later in the session as well. But we're really seeing the emergence of this idea of a two-tier economy, which is where consumers who have high levels of discretionary and disposable income are not changing their retail habits as much as consumers in the lower and middle income brackets. So luxury in certain aspects continues to do very well with, again, those really high income consumers. Where they're starting to lose momentum is with those more aspirational buyers. So kind of where we're looking at the more challenged businesses, again, it continues to be businesses that really attract a more middle class consumer. So your mid-tier department stores, as well as kind of your full price apparel products. And this is where, again, we're continuing to see this concept of the squeeze of the middle, that retailers that are definitely more challenged are the ones that traditionally cater to a more middle class audience, that as those consumers become more financially and economically constrained, this has started happening over the past few years. We expect this to continue over the next few years. This is really where those retailers are becoming much more challenged.
So, Elizabeth, can I ask you a question on this one? So,
Yeah,
in that off-price apparel category, is that literally just the off-price pure play players, or does that also include the outlets?
this would include just the pure play players, but outlet business has also been actually, the outlet business has been kind of interesting because we have seen a deceleration in those businesses as well, and a sort of a deceleration in visitation to outlet malls overall. Again, I think as consumers are sort of weighing their discretionary purchases, they're being as picky as they possibly can. But this would be pure play off price retail.
Thank you.
Of course.
I have another question on home furnishings. So, on home
Yes.
furnishings, is that like, does that include places like Home Goods, or would
Yes.
Home
So
Goods? Okay, go ahead.
home goods would be included in this. So certainly the off-price element of home furnishings is also driving the business, but we
Okay.
have also seen strong performance from retailers like Michael's, World Market, Hobby Lobby, those players as well, which would be included in here.
Awesome. Thank you. Wow. This
Of
is a great
course.
review, kind of a landscape. So now let's try to go and dive into some of the details, and maybe you can give us your take on the future of physical retail stores.
Yeah, that is a great question. And really, what we're going to start to talk about over the next few slides is sort of store formats that are working, categories that are doing really well, and really, again, just sort of changing consumer behavior. And I think that we've talked about this in the sessions that we've done over the past year and a half, that physical retail is not dead. I think it is just evolving. And really, what we are seeing right now is that there's a consumer pullback from all types of the retail industry, that we're also seeing it in online as well as stores. Now, certainly stores, we have that sort of impulse purchasing element, that consumers walk into a store, they see something they didn't know that they need, and they walk out with it. Now, there is a lot more risk to that type of behavior in sort of a more financially constrained and more financially constrained economic environment for consumers. But we are still seeing that physical retail is a key part of the consumer's daily, weekly, and monthly routine. And even though it's evolving, it's definitely here to stay. So, with all of that said, talking about one of the retail formats that continues to do very well is dollar store channels. Now, part of this is due to just the expansion of the fleets and of the major banners over the past few years. But we have also started to see sort of two things converge at the same time around dollar stores. So, one is macro related. As consumers are in lower and middle income households are becoming more financially constrained, we are seeing this trade down effect. So somebody who might have been a full price shopper, maybe traded down into superstores, and now they're trading down into dollar and discount chains. And these stores have really benefited from the current economic conditions. Now, at the same time, kind of the other half of the coin is that it's also related to changes and strategies that dollar store chains have implemented. So expanding grocery assortments, adding more fresh produce and other types of categories within the store, expanding assortments to a bunch of other categories that they didn't have before, as well as opening stores in locations that are beneficial to the consumers that might be living in that area. So both of these kind of factors together have created a great sort of tailwind for dollar store chains to really experience some great growth. And one of the other points that I think is really interesting looking at the slide here is that we've seen an increase in loyal visitors when we're comparing 2019, 2022, and 2025, the first half of each of those years. We're seeing a much higher percentage of loyal visitors, which would be defined as visiting 2 times a month. So again, when we're thinking about that trade down effect, not only are dollar stores done a great job of that category expansion, so that when consumers go to these chains, they feel like they can get more of their shopping done in that particular location. But also with the trade down effect, we're seeing that consumers are becoming much more loyal to these chains overall. And both of those have really kind of created this perfect storm that benefits dollar chains. So we kind of alluded to the performance and bifurcation of superstores and warehouse clubs overall, but I kind of want to dig into a little bit more about why Costco has been sort of a key retailer to watch in 2025 and really what they've been doing so well. So it's been really interesting to see sort of the deceleration of the superstore business overall, both from Walmart and Target. Walmart, we have seen a lot of shift from physical retail visitation into some of their online channels. They have a very strong delivery service. They have very strong online business. So we've kind of seen a shift in Walmart's business overall away from physical retail visitation into some of their other channels. But what's been really interesting is the rise of the warehouse club in 2025. And I think that this does sort of underscore a changing of the tides in which we're kind of viewing these concepts of one-stop shops for consumers. That it used to be that if somebody wanted to do all of their shopping in one place, a superstore was sort of best equipped to do that for consumers. We have started to really see that change and that consumers are now viewing warehouse clubs as that place where they can one-stop shop. Now, certainly they are buying in bulk and potentially buying more and different types of products than they're used to. But when we also factor in the gas station component of warehouse clubs or the multi-service approach that warehouse clubs have, where people can go and get their eyes checked, order their contacts, fill their prescriptions, book a vacation, have their cars serviced. All of these different types of things are creating this amazing customer experience for consumers. And again, as consumers are value oriented, they also feel like they're getting a great inherent value for their membership at these warehouse clubs. We also sort of have the factor of millennials and Gen Z who are aging into family formation, potentially moving into larger spaces, becoming members for the first time. But all of these things together are really creating, again, great tailwinds for warehouse clubs overall. And I think a huge shift that we're seeing away from superstores as being viewed as the only one-stop shop option out there. And we're now seeing that both from the warehouse clubs and dollar and discount chain perspective. So I touched on this a little bit earlier in terms of talking about the concept of the two-tier economy. But if you take, I think, one thing away from this session in terms of thinking about holiday 2025 and the trends that we're going to see emerge in 2026, I think the concept of the two-tier economy is something that is only going to get stronger as we continue to kind of move through the calendar year. And as consumers, again, some consumers become even more economically constrained and a little bit more price sensitive overall. So the concept of the two-tier economy is that we're continuing to see strong spending, strong visitation from, again, those highest income households. And we're really starting to see a huge pullback in retail demand from lower and middle income households. And that has gotten, I guess that chasm has gotten wider as we have gone throughout 2025. And it continues to get wider pretty much every single week and every single month that we're tracking foot traffic across the retail industry. So, a few different ways that we can see the two-tier economy emerging is looking at, on the left hand side, we are looking at full price apparel compared to off price retail. Now, again, this is something we've seen the growth of off price retail across consumer demographic breakdown. So it's not necessarily only being driven by those lower and middle income shoppers, but we are seeing a decline in sort of full price categories overall as lower and middle income consumers, again, become a little bit more choosy with their purchasing and a little bit more discerning in terms of the types of retailers they're going to shop and what types of value and promotions they're hoping to get out of those retail visits. Now, where we are seeing some kind of spikes in demand for those full price categories is traditionally when there are promotions or it's sort of those highly promotional weeks. Now, on the flip side, on the right hand side, we're looking at upscale and fine dining chains, and we're looking at the visitation to those versus your traditional quick serve restaurants. And again, we are seeing a deceleration in visitation to quick serve restaurants. So consumers who might have been doing that as a convenience option are now looking elsewhere. They might be trying to source more food at home to save money, but we're not necessarily seeing this huge dip in visitation to fine dining restaurants because consumers in those higher income households, again, with more price elasticity and disposable income, have not necessarily been changing their behaviors that much overall. So another interesting thing, and I think this is a concept that we have also talked about on these sessions over the past year and a half, is the concept that as we think about sort of physical retail going forward and how retailers kind of, aside from the consumer element of this, think about their store fleets going forward and think about optimizing the store channel for themselves. One of the things that kind of we keep repeating is that it's not just about the size of a retailer's fleet, it's about the type of the retailer's fleet, meaning that it's not just about opening new retail locations or closing certain locations. It's about opening the right types of store formats in the right types of locations for the retail industry. And one of the kind of, I think, key consumer trends that we've observed over the last 5 years through our foot traffic analytics is the migration of consumers over time. So meaning consumers migrating out of your major kind of urban environments into more rural and suburban environments, into these more kind of second tier cities across the US, and into more kind of suburban areas surrounding your major urban markets. So what this has really done is it's changed the need for consumers in terms of how they approach the retail industry, how they shop stores, what their daily and weekly routines look like. And the retail industry has to evolve to make sure that the store formats that they're opening are not only in the right locations, but they're meeting the needs of these changing consumer dynamics over time. So what we can see for the third quarter is when we're looking at store format, and this is looking at the grocery industry in particular, is that we're seeing growth out of small format grocery. And this is really being driven by your sort of fresh format grocers. So Sprouts being kind of the big one that has continued to see huge success in opening small format stores. But on the flip side, we're also seeing, again, growth and visitation to mega grocers. So when we think about sort of those major regional chains like an H-E-B opening those 150,000 square foot stores and even larger that have, you know, a bar in them or a restaurant in them or all of these different types of extra services that consumers can get in these major stores, both of these formats are sort of outpacing your traditional grocery store. So what this really tells us is that retailers that are being innovative and strategic in terms of opening different types of store formats to fit the individual needs of the areas that they're going into, those are the retailers that are really winning. And I think, again, another thing to take away from this is that the future of retail is local and hyper specific. That retailers need to do a better job of really not taking a one size fits all approach and really listening to the individual needs of individual communities to make sure that they are engaging in the right way going forward. So, one of the kind of interesting things, and another sort of category trend that has emerged, and this is something that is not, I think, a new concept. We've seen this every time that there is a economic downturn or lower consumer sentiment overall, is that we're seeing again this concept of small indulgences really come back into the fold in 2025. It's interesting because we are kind of also seeing this in conjunction with a deceleration in the beauty industry, which are two things traditionally are kind of headed in the same direction. And we're seeing that now beauty is decelerating. At the same time, we're seeing small indulgences increase. However, what we have started to see is that, again, consumers are really looking to reinvent themselves where they can, but they're also looking to, again, have those small sort of bursts of joy that they can implement into their daily and weekly routines when they can. So maybe that's a visit to a coffee shop. Maybe that's buying a new piece of cosmetics that, again, they want to want to treat themselves. I think so. Again, just think about the idea of small indulgences. I think that this is another thing that we can think about in terms of home decor and full decor and all of these things we're thinking about with home furnishings as well. All of these together, again, really creating this concept of small indulgences.
I love how you take the beauty, fitness, and coffee and kind of look at it as three different areas of business, which I don't think a lot of people look at it that way. So I love these insights. They're amazing.
Yeah. I know. I think that that's one of the really interesting things about doing this type of work, but also with data and insights, is that a lot of times things that are industries that are not correlated at all, if you look at them individually or you look at them together, it starts to put together this narrative that we normally couldn't. We're just looking at them in a silo, but putting them together actually creates this large that I might not thought about even. So our last slide, kind of before we get into back to school and holiday and all of the fun stuff to wrap up 2025, is again, one of the things that I mentioned before is the squeezing of the middle, which again is not a new concept. But I do think that when we're thinking about retailers that are focused on meeting the middle income consumer right now, figuring out where else those consumers are shopping, I think is really eye-opening in terms of figuring out strategies going forward and how to treat those customers and how to be a partner to those customers during these sort of more economically challenging times. Because ultimately, as retail, like our job is to make consumers happy and to give them a little bit of a reprieve and to brighten their day. And so figuring out how to do that against the headwinds of everything that's going on is really important. And kind of understanding the consumer behind that is going to be helpful in making those decisions going forward. So all of that to say, so what we are looking at here is one of the things that I think is most interesting about Placer's data, which is called visitor journey. So this allows us to look at the share of visitors who shopped at Macy's and where else are they going within the third quarter of the past 4 years. So what's interesting here is that you can see that the Macy's customer overall has become much more value oriented over time. And this is obviously something that we're seeing across a lot of consumers, but it's pretty drastic when we're looking at shoppers who shop at Macy's, that they are also now looking for off price, which there was a lot of cross correlation with between that to begin with. But seeing the huge increase in shopping at Costco and also shopping at Aldi and shopping at the Dollar Tree, all of these different things tell us that the Macy's customer is becoming more value oriented over time. So thinking about how that looks in terms of marketing efforts, how that looks in terms of the promotional calendar, how that looks in terms of pricing, how that looks in terms of where the stores, what else is around those stores and around those shopping centers. It really helps us to kind of understand better who these consumers are and how their values are changing over time so that we can continue to meet those needs because the customer today looks wildly different than how they looked in 2019. And they probably look wildly different than how they're going to look in 2030. So really being able to adapt with consumers is very important.
So, Elizabeth, before we jump into our next section, can I ask you a
Yeah.
few questions? I have some
Yeah, of
audience questions
course.
as well.
Yes.
So, one of them, if you go back to the future of store with the Walmart, Target, Costco slide, that seems to create
Yes.
a lot of interest. But one question is when you look at Walmart and you see physical retail and the move of Walmart customers doing less store visits, do you think that the more and more digital visits, is it because of BOPIS or Shipt? And how are you able to count that into these analytics at all?
Yeah, that's a great question. So our data would cover essentially curbside pickup as well as buy online pickup in store. So if a consumer went into the store to pick up the purchase or if they pulled into the parking lot, because we are able to, again, draw that perimeter around the parking lot. So this would include those types of services. What we could not capture is potentially the Walmart Plus delivery service where somebody is delivering that item to a home. We wouldn't necessarily be able to capture that visit. And I think that definitely there's been a shift of Walmart shoppers into their digital channels. They've done an amazing job at really excelling in a digital first strategy as a retailer. But we have also seen too that the traditional shopper of Walmart and their consumer base, again, has become more financially constrained. So there also is an element of trade down here where we are seeing, again, the growth of the dollar and discount chains, that we are seeing that more high income shoppers are shopping at Walmart for the first time. But also on the flip side of that, more lower and middle income shoppers who might have been traditional kind of core Walmart shoppers are now trading down into other options, either value grocers or dollar and discount chains.
The other thing that's interesting about this slide is when you talk about Costco and what a great job they're doing, and some of that may be related to the apparel and the private label. Do you think that their kind of focus on apparel private label as these consumers are trading down are helping the company grow in terms of visits and stuff?
Yeah, that's a fantastic question. And I definitely think that the strength of the Kirkland brand has been a huge benefit to Costco. And I think that Sam's Club also has a very strong private label program, which has helped them as well. I think that one of the things that we've seen that we haven't really talked about is that private label is a huge benefit to consumers during kind of challenging economic times. And we've really seen consumer adoption of private label products over the past few years, that consumers no longer see these store brands as inferior. A lot of times, I think in the case of Costco, consumers see Kirkland brand as actually being better than national brands sometimes. And it's a brand that consumers have really put their trust in. They've bought into it. They feel really strongly about it. And it's definitely benefited Costco, I think, from the apparel side, but also I think across the store in every single category.
Thank you. Okay, so let's move forward. Maybe you can share with us lessons from back to school and get out your crystal ball and tell us what your insights are for holiday.
Yeah, it's a great question. I truly wish I could anticipate what's going to happen every single week of the holiday season. I can't believe that we're technically already in the second month of what we consider the elongated holiday season at this point. Time is moving too quickly, but kind of to take us back just a little bit before we get into the holiday season, I wanted to briefly kind of call out what we saw in back to school and some of the lessons that we think the industry can take away from as we get into sort of the core element of the holiday season. So this is looking at the weekly visits compared to the year-to-date weekly average of 2025. So we're looking at essentially weeks during the back to school season, beginning in July, running through the end of September, sort of compared to the weekly average of visits across 2025. And what I think is really interesting, and this is sort of the two key takeaways from back to school, is first that back to school started earlier than ever. We really saw a lot of momentum for back to school categories in that early and mid July timeframe. So it's kind of no coincidence that is when Prime Day is. A lot of retailers have created retailer deal days around that event. But we have seen that the back to school season is shifting earlier and earlier. And this is kind of indicative of what we have started to see during the holiday season as well, that a lot of that demand is again being pulled forward into October. Same way we're seeing a lot of back to school demand being pulled into July. Now, the other thing that we're seeing here is that when we have seen spikes in performance, it tends to be around those key promotional tentpole events. That when consumers are thinking about their back to school purchases or their holiday gift purchases, again, trying to derive as much value out of those purchases as possible, they're really focused on coming out during those key tentpole promotional events. So that is really important again to think about as we get into the holiday season because it means that events like Black Friday, Cyber Monday, Super Saturday are most likely going to become even more important to get right from a pricing perspective, a promotion perspective, a location perspective, a staffing perspective. All of those things are really important for the industry to get right because that is when we are getting consumers' attention the most. So making sure we can hold it and convert it is really important going forward. So, holiday expectations. Again, I kind of alluded to the top two that we just saw, but this is looking at daily visits during last year's holiday season compared to, again, the daily average that we saw. So, one of the things that was really interesting about 2024 that is also happening in 2025 is the 4 week window between Thanksgiving and Christmas, which traditionally we have about 5 weeks. In 2024 and 2025, we're going to have 4 weeks. So, we are comping against last year. But what's really interesting is that one of the kind of key learnings that we took away from last year was that December 23rd was a huge day for the retail industry, which traditionally is not necessarily the case. And part of that we think is because with this shorter holiday window, it really does sneak up on consumers. And a lot of consumers miss the e-commerce shipping windows. So then they are forced into the store at the end of the holiday season, just before Christmas, to get those final purchases, to look for those kind of final deals. And I expect that this is probably going to happen again this year because we know consumers are being a little bit more selective, a little bit more discerning. People might end up waiting until it's too late, just trying to wait for the best deal possible. So we might see again a lot of traffic move into physical retail locations at the end of December, just before Christmas. The other thing that we really saw was that for a lot of retailers, what really helped them make their holiday season last year was October. So think about the Prime event that we see in middle of October, a lot of these deals that are pulled into October. We are seeing that for consumers who are trying to get deals and get all of their purchasing done as early as possible, again, kind of due to economic headwinds, we are seeing a lot of that demand again shift into October. And while we're kind of tracking behind what we saw in October of 2024 from a visitation perspective, we did see a jump up from September. So that indicates to us that, again, October is going to be very important. We just closed out. So as we get into November and December, whatever we didn't make up in October is going to be really important going forward. And finally, as we think of sort of about how individual industries are going to perform, how we're going to think about sort of these key temple events, this is looking at the performance by category year over year for each of sort of the major holidays that we've already had in 2025. And what I think is really interesting here is that we see different categories perform better or worse during individual events. So really, whatever type of retailer you are, whatever type of CPG brand you're focused on, making sure that you know when your consumer is most engaged with your category is really important, especially as we get into kind of Black Friday, Cyber Monday. Knowing when categories do best for consumers is really important to, again, thinking about promotional marketing, store staffing strategies going forward. But overall, as we can see, even with kind of a variety of performances by category in 2025, we have seen a lot of deceleration in sort of our major full price gifting categories throughout the year. So that does mean that retailers are going to have to work even harder this holiday season to not only get the consumer's attention, but actually convert them into the store to participate in a lot of these promotional events in 2025. So with that, I will take any final questions. And,
Great.
considering everything that we've talked about, there are obviously a lot of headwinds for the industry, but I think that we are still seeing a lot of consumer resilience. I think holiday this year is even harder to predict than we've ever seen in the past. So it is really going to be taking things on a week by week basis. But here's to hoping that consumers continue to turn out and that we see some better sentiment as we get towards the end of the year.
It's really interesting how Prime Day has completely shifted our back to school and holiday calendars
Yes, it has.
over the years. So, and I think on December 23rd, it was a Monday. And
Yes,
so,
it was. Uh-huh.
right. So I'm sure does that play into day of week and when the 23rd or the 24th or the holidays land on? I'm sure makes a big impact.
It does, I think, to a little bit because traditionally, when Christmas falls earlier in the week, that's when we see such a big Super Saturday. But to see a Monday perform so well last year compared to the Super Saturday that was just 2 days before was really, truly, I think, indicative of the fact that when we have a shorter holiday season, consumers just, it sneaks up on them. And with shipping windows being what they are, there's so many consumers that miss the deadline.
Yeah. So another question I have is, okay, so I've heard rumor that there's a lot of gift cards out there, and gift cards are a great way during an economy where people trying to budget money more seriously. That is a great way for them to budget holiday spending. How does gift cards then impact the visits? Is it shift them later? What happens with a big gift card year?
Yeah, that's interesting. I think traditionally what we see with gift cards is that is usually the week after Christmas when we're seeing a lot of people redeem gift cards that they might have been given or, shopping the sales in late December throughout January. That is traditionally when we see a lot of gift card redemption. But I think it'll be interesting because I think that if we see a lot of gift card circulation, that could potentially spur a little bit more consumer demand, a little bit more consumer visitation, because consumers feel like they have some discretionary income to play with. And that would be really beneficial across the board.
That's great. One last question is at the beginning, one of our audience members asked about you're helping with finding locations. So can you talk a little bit about how Placer AI helps with location strategy?
Yeah, yeah. So we can certainly help with or location analytics and kind of site selection. And really what we're able to do is look at various markets and sort of understand consumer movement, understand potential trade area cannibalization. So depending on the number of retail locations or competitor locations in an area, we were built as a commercial real estate tool originally before finding out that we had a bunch of applications across many different verticals and many different industries. So we were really built to help retailers understand their current fleet and where they can optimize that going forward.
That's amazing. Well, thank you.
Yeah.
And I love having you on. I always learn so much. And like I said, I love how you take the different families of business and kind of create these great insights. So, is there anything else you'd like to say before we say goodbye to our audience?
I think final thing I'll leave you with is one of I think the best things that we do is play with Placer is our Anchor site, which we post daily blogs. We have white papers. My team writes a bunch of different stuff. There is such a wealth of information, and you can truly get a pulse on what we are thinking about and the things that we're really focused on. We've put out holiday predictions on that site. So if you go to Anchor or placer.ai/anchor. You can find all of our content there. It's updated very regularly, and there's such a wealth of information.
I love your site. I always pull information off of it. So, thank you for having that and continuing to add great content.
Yes, thank you so much, everyone. Appreciate you being here.
Thank you.